Well, I think we need some transparency. We need to see where the poor or underperforming assets are. We need to see how much exposure these banks have got to, say, Spanish property market or to Eastern Europe or to sovereign debt amongst the so-called PIGS, sovereign debt markets. There has just been a lack of transparency. Europe has been rather slow in this respect. Not surprising because you have a patchwork quilt of different national regulators concerned. But now under the auspices of the European Committee on Banking Supervisors, these tests are coming out. So I believe that will be helpful. I believe they know they have to give a certain amount of information. Spain in particular has been pressing for maximum disclosure, and presumably they must feel that their situation is less bad than the market anticipates. Germany has been dragging its heels, presumably because the Landesbank and the state-owned regional banks actually still have a lot of underperforming assets on their books. So I think they realize a lot is hinging on this, and I don't think they'll fail investors from that point of view. They will provide quite a bit of information. In that sense, it could actually be a catalyst, as it was in the case of the US in 2009. Well, firstly, they need to be reasonably severe. They need to be stressful. And I think taking 3% off the growth assumption when some of these economies are already predicting negative GDP growth, in the case of the likes of Greece and so on, plus a fairly decent haircut when it comes to sovereign debt of the southern European governments. And there, Greeks prices are already down 25%, and if we take a further 16% off that, that's a 50% haircut, which is almost like similar to a default value if you assume 30% recovery rates. So I think from that point of view, they will be realistic. And then we will want to see where banks do have a deficit in terms of Tier 1 capital, that meaningful steps will be taken by the national authorities to make those banks come up to standard within a 12, 18-month horizon. Well, I think one of the risks is just that there'll be this stream of continuing poor macroeconomic news which will kind of depress investors elsewhere. Also, there could be disagreement as to whether a restructuring should go ahead for Greek debt, and possible political, a degree of political instability or disagreement coming from the Eurozone. That would be very negative, I think, for everyone. In terms of actual growth expectations, the Eurozone economy has not made a major contribution to world growth in the last 5 or 6 years. It hasn't contributed more than 10% to overall global GDP growth. So I think a sluggish Eurozone economy would be perfectly acceptable. That would not derail growth expectations in the rest of the economy.